Another key element in financial analysis is company valuations. Teams often get asked, what is the company worth or what is the project actually worth? I've coached 302 Haskane teams to over 180 podium finishes. They will cover the main valuation approaches: asset based, market based, earnings based, and cash flow based, plus rules of thumb and important considerations. This is part of the Case Finances and Excel Mastery series. Turn numbers into compelling insights. Let's make your valuations credible. Asset-based valuations look at what a company's assets are worth. There's book value, straight from the balance sheet, adjusted book value, modified for current market values, and removing items that shouldn't be there. There's replacement value, the cost to replace the assets today. And finally, liquidation value, what could you get if you sell everything off? This last method sets a clear floor price, useful when assets are the main value driver. Market-based valuation uses price-earnings ratios of similar public companies. It's straightforward for public firms, but harder for private ones due to a lack of comparables. Earnings-based valuation takes normalized earnings, removes the one-offs, and divides by capitalization rate that reflects the business's risk. For example, 15% for a small, stable, small business, up to 50% for a high-risk one. This gives a value based on the ongoing earnings power. Cash flow-based valuations use things like the discounted cash flow or Pierce method. It forecasts future cash flows and then discounts them back to today. The discount rate includes a risk premium, so 6 to 10% for a stable business, 21 to 25% for a highly cyclical small business. There's also a number of rules of thumb that can help for quick checks. Private SMEs, 3 to 5 times EBITDA or 1 to 3 times cash flow. Accounting firms, 100 to 150% of annual revenue. Things like bookstores, 15% of annual sales plus inventories. You can always combine the methods to also set a more realistic range. And there are a number of other types of rules of thumb that can help you out in terms of valuing a company. Some issues are important considerations. In an owner-managed business, watch for the my baby premium. Owners often overvalue their company. Debt is senior to equity and requires interest payments. Equity dilutes ownership, and it can also affect the control. Other factors are legal and environmental issues, union contracts, strategic alliances, location advantages, and succession planning. Present a range of values and explain your reasonings so the judges see that you've thought through the valuation critically. There you have it, the main company valuation methods and how to use them incredibly in a case. This is part of the Case Finances and Excel Mastery series, turning numbers into compelling insights. Drop a comment. Which valuation method do you find most useful or challenging in cases? Subscribe and hit the bell for the rest of the series. Cam Welsh out. Go value companies realistically and strengthen your every recommendation.